There's a really good chance that you aren't fully optimizing your TFSA, RRSP, and FHSA, and it could be costing you thousands of dollars. I often see our clients make costly mistakes, and today I'll show you which accounts to prioritize to avoid those pitfalls. Stick around to the end where I'll go over how to unlock free money using government grants. The big three. Which should you prioritize? FHSA, RRSP, or TFSA? Let's start with choosing between the big three because I find this is where most of our clients struggle with. Here's the case for why the FHSA should be your first pick. If you're saving for your first home, the FHSA is an excellent starting point. Why? It gives you the best of both worlds, tax-deductible contributions like an RSP, and tax-free withdrawals like a TFSA, as long as it's for a home purchase. This makes it a win-win for young savers and future homebuyers. But here's the best part. Even if buying a home isn't in your immediate plans, the FHSA is still the smartest option in a lot of cases because you can invest within the account and let your money grow tax-free. If you change your mind later, the funds can easily be transferred into your RSP. The flexibility allows the FHSA to adapt to whatever your financial goals might be down the line. And here's a pro tip. The FHSA can be used as kind of a form of income splitting. A higher income spouse can gift up to $8,000 annually to their lower income spouse, who can contribute that to their FHSA. The growth on those funds remain tax-free, and the lower income spouse gets a tax deduction. The only reason that I could think of where you might hesitate to contribute to the FHSA before maxing out your TFSA is the need for flexibility. Because if you withdraw from the FHSA for a non-qualifying purpose, for example, if you want to buy like a car and you take out money from your FHSA, you permanently lose that contribution room from your FHSA. So as an example, an emergency fund would be better held in a TFSA over an FHSA. All right, next up is the TFSA versus the RRSP. Which should you contribute to first? Choosing between a TFSA and an RSP really depends on your income, goals, and the need for flexibility. Let's break down when each account makes sense for you. The TFSA is all about flexibility. You can withdraw your funds tax-free anytime, making it perfect for both short-term goals and long-term investments. The simplicity of the TFSA also shines. There are no complicated withdrawal rules or tax implications, as long as you respect the contribution limits, making it a user-friendly option. The key points is its flexibility. You can withdraw the funds at any time, tax-free without penalties. That makes it ideal for both saving and for short-term goals like vacations or, say, a new car or for emergency funds while still providing tax-free investment growth. The second key point of the TFSA is the simplicity. Unlike the RRSP, you don't need to worry about tax deductions or complex rules. You can contribute, withdraw, and then recontribute again the next year, within your contribution rule, of course. So when should you prioritize the TFSA is when you want easy access to your funds without penalty, you're saving for short-term goals like vacations, big purchases, or emergencies, you're in a lower income year, so RSP tax deductions won't give you as much benefit, and you're looking for a simple way to grow investments tax-free without locking in your funds. And to learn more about what to invest in your TFSA, check out another video on my channel about how to get to $1 million TFSA. All right, let's talk about the RRSP now. The RRSP is built for long-term retirement savings, offering tax deductions now while your investments grow tax-free until retirement. It's a must for higher income earners or anyone with employer matching contributions, as that's free money you shouldn't pass up. When to prioritize RRSP is when you have a higher income and need the tax deductions to reduce your taxable income. Another key reason that's often overlooked is you can use RRSP to qualify for government benefits like the Canada Child Benefit or GST HST credits by controlling your income in those key years. So to summarize comparison of the TFSA and the RSP, choose the TFSA first if you need flexibility, are in a lower income year, or want a simple tax-free way to save for both short and long-term goals. You could choose the RSP first if you have a higher income and want immediate tax savings, or if your employer offers RSP matching. So overall, I would say go with the FHSA first and then consider either the TFSA or RRSP depending on your situation, and go with the TFSA when in doubt. But there are three very important exceptions to that order. Don't forget about the RDSP, the RESP, and RRSP employer matching. Each offers unique benefits and free money opportunities, which I'll get into now. The RDSP, which is long-term disability savings. The RDSP provides major support for Canadians with disabilities, offering substantial government grants and bonds. The Canada Disability Savings Grant, or the CDSG, matches 300% on the first $500 you contribute and 200% on the next $1,000, allowing you to receive up to $3,500 per year. And the Canada Disability Savings Bond, or the CDSB, provides up to $1,000 annually without requiring contributions. So as an example, if you contribute $1,500 to an RDSP, you can receive up to $3,500 from the CDSG and $1,000 from the CDSB for a total of $4,500 in free government support each year. This is a very powerful tool to help families build financial security for a loved one with disabilities. Now the RESP. RESPs help families save for post-secondary education, with the Canada Education Savings Grant, or the CESG, matching 20% of contributions, up to $500 per year per child, for a lifetime max of $7,200. So for example, if you contribute $2,500 annually, you'll get 20% of that, or $500 as a grant from CESG, which boosts your savings. And this automatically translates into an easy 20% return on your investment automatically. Lower income families can also benefit from the Canada Learning Bond, or the CLB, adding up to $2,000 without requiring contributions. Starting early maximizes growth, especially when combined with compounding. Then the RRSP employer matching. If your employer offers RRSP matching, don't miss out. It's free money. As an example, if your employer matches 50% of contributions up to $1,500, that's an instant 50% return on your $3,000 contribution. Employer matching not only helps you grow retirement savings faster, but also adds discipline to your savings habits. Always maximize RRSP matching if available. Of these three, I would prioritize these accounts first. The RDSP if you qualify, because it's very generous government grants for disability savings. And then the RRSP employer matching, because you could take advantage of free employer contributions. And then the RESP for saving for education with a 20% government grant. These accounts should come even before the TFSA or FHSA due to the free money advantage. Okay, let's talk about non-registered accounts now, which is the final destination. After maximizing your FHSA, TFSA, and RRSP, non-registered accounts are last. Though they lack tax advantages, you could still grow your wealth wisely in these accounts. What's ideal assets for these non-registered accounts? To minimize taxes, avoid interest income, which is taxed at the highest possible rate. Instead, I would focus on growth stocks with no dividends. Growth stocks such as Shopify, Nvidia, and Amazon are ideal for non-registered accounts since capital gains are taxed lower and only when sold. Just make sure you do your due diligence before investing in higher risk growth stocks. And the second thing to consider are Canadian dividend stocks. Take advantage of the Canadian dividend tax credit to lower taxes on eligible dividends. For example, if you get paid a $1,000 dividend, it's grossed up to $1,380, resulting in a 15% federal tax credit, which reduces your taxes by $207. Provincial credits further help. What I would avoid though in non-registered accounts are US dividend paying stocks, which face withholding taxes and also don't qualify for this credit. So which one should you choose first out of all these accounts? To make the most of your savings and minimize taxes, here's the final order of priority I would consider for investing, if you qualify for each of these accounts. I would first choose the RDSP if you qualify because they have the most generous grants, and then I would choose the RSP with employer matching. You could prioritize this for free employer contributions. And then the RESP, which provides a 20% government match up to $500 per year for education savings, plus it acts as kind of a form of income splitting. Then the FHSA, which is best for first-time home buyers with tax-deductible contributions and tax-free withdrawals. And then the RRSP or the TFSA. RSP for higher income tax deductions, and TFSA for flexibility and tax-free growth. Then finally, it would be the non-registered accounts with a focus on growth or Canadian dividend stocks for tax efficiency, and I would avoid US dividend stocks. Remember, the right account for you depends on your personal financial goals, income, and savings needs. Subscribe for more tips and visit Blueprint Financial for personalized planning services to help you hit your goals faster.